Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Barrick Gold stock so we can determine if it's a buy or a sell. Barrick Gold is a mining company that produces gold and copper. It has mining operations in Argentina, Canada, Chile, Cote d'Ivoire, Congo, Dominican Republic, Mali, Papua New Guinea, Saudi Arabia, Tanzania, the US, and Zambia. Barrick was the largest gold mining company until Newmont acquired Goldcorp in 2019. Now Newmont is the largest. The company is headquartered in Toronto, Ontario, Canada, and was founded in 1983. Let's get started with the model. This is a large cap company, 36 billion market cap. They're trading at $20 a share, and they have 1.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It looks like a similar trend as Newmont. It jumped up a lot from 2019 to 2020, reaching 3.4 billion, dropped in 2021, then dropped again in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was highest in 2019 at 4.5 billion, dropping to 3.6 billion, down to 3.3 billion, then way down to 1 billion. But their revenue in 2022 wasn't that much lower than 2021, but their free cash flow net income were a lot lower. This would be a good time to really dig into their financials to figure out why. Let's look at the capital structure. 23 billion of equity, 5 billion of debt. They're 81% equity, 19% debt. And they could pay off most of the debt with the cash on their balance sheet. If they did use all the cash on their balance sheet to pay down debt, they would only have 800 million of debt left over. And they have a pretty low WACC, 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 39 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $35 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of $19.34. They're trading at $19.98, so they're trading at a 3% premium. It's a sell according to the model. Wow, Simply Wall Street values them at $13. They're saying it's 52% overvalued. Most of the time, Simply Wall Street has stocks really undervalued, but not in this case. 10 analysts price this stock, and the average price target is 23. The low is 19, the high is 28. Another 11 analysts price this stock, and the average price target is 22. They're saying it's 10% undervalued. This is where the stock has been trading since 2002. In the very beginning of 2002, the stock was about $15 a share. And then 6 years later, in 2008, it broke through 50. Then the Great Recession hit. The stock came down to about $20 a share. Then it jumped up real fast over the next 2 years, breaking through 50 again. It got really low in 2015, 2016, below $5 a share. And it just broke through $30 in mid-2020, but it's come down about 20 or 30% since that point, sitting around $20. They pay a quarterly dividend, and you can see it's all over the place because a dividend probably moves with the price of gold. If gold gets really high, so do their profits, and so does their dividend. Then vice versa when the price of gold gets lower. So their last dividend was 10 cents. They did pay a 20-cent dividend in 2022, a 23-cent dividend in 2021. But look how low it was in 2018, only 3 cents. The yield is exactly 2%, which is 72% of their net income, 169% of their free cash flow. There are 43 companies in the same industry as Barrick, and if Barrick has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend more than any other company in CapEx, over $3 billion. They have a good debt-to-equity ratio. It equals the median. Only 20 cents of debt for each dollar of equity. Their dividend is a little larger than the median, a lot lower than Newmont, also a lot lower than B2 Gold, and lower than Centerra. They generate positive free cash flow, so it's higher than the average and median. They're second largest in market cap behind Newmont. Their ratios are worse than average in every category. Their price to free cash flow is really poor. They generate a lot of revenue, over 11 billion. Their 5-year annual revenue growth rate is only 6%, which equals the median. Lower than Newmont, but a lot lower than Franco-Nevada, and also a lot lower than Agnico. They do have a positive ROA and ROE, but they're not good numbers. They're really low. So to summarize, I have them trading at a 3% premium. I rank their free cash flows 3 out of 10, their revenue 5 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.